Have you ever wondered if that tax advice your uncle gave you at Thanksgiving dinner could actually land you in hot water with the IRS? What if I told you that some of the most widely believed tax facts are actually complete fiction, and believing them could cost you thousands of dollars or even trigger an audit? Today we're diving deep into the shadowy world of tax mythology, where common sense often leads us astray, and the truth is far more surprising than you might expect. I'm about to reveal 10 tax myths that are so pervasive, so deeply embedded in our collective understanding of taxes, that even seasoned professionals sometimes fall for them. But here's the kicker. By the end of this video, you'll not only know the real truth behind each myth, but you'll also understand exactly why these misconceptions exist in the first place, and how to use this knowledge to your advantage. Let's start with perhaps the most dangerous myth of all, the belief that getting a big tax refund means you're winning at taxes. This misconception has convinced millions of Americans to celebrate what is essentially their own financial mistake. When you receive a large refund, you're not getting free money from the government. You're getting your own money back. Money that you've essentially loaned to the government, interest-free, for an entire year. Think about this logically. If you gave your neighbor $1,000 in January, and they returned it to you the following January without any interest, would you consider that a good deal? Of course not. Yet, somehow, when the IRS does exactly this through over-withholding, people throw parties. The optimal refund amount is actually zero, meaning you've calculated your withholdings perfectly to match your tax liability. Every dollar you get back in a refund represents money that could have been earning interest in your savings account, invested in the stock market, or used to pay down high-interest debt. The second myth that's costing people serious money is the belief that making more money automatically means you'll take home less because you'll jump into a higher tax bracket. This fundamental misunderstanding of how progressive taxation works has actually prevented some people from seeking promotions or taking on additional work. Here's the reality that will probably surprise you. Tax brackets only apply to the income within that specific range. Let's say you're single and earning $60,000, putting you in the 22% tax bracket for 2025. If you get a raise to $70,000, only that extra $10,000 gets taxed at the next bracket rate. Your first portion of income still gets taxed at the lower rates. The effective result is that earning more money always results in taking home more money, even if the additional income is taxed at a higher rate. This myth has literally prevented people from advancing their careers based on a complete misunderstanding of basic tax mechanics. The third myth revolves around the idea that you can deduct anything if you use it for business purposes. This has led to some truly spectacular audit failures, where people have tried to deduct their morning coffee, their gym membership, or even their pet expenses by claiming some tenuous business connection. The IRS has very specific requirements for business deductions. They must be both ordinary and necessary for your particular type of business, and you need to maintain detailed records proving the business purpose. That daily Starbucks run isn't deductible just because you sometimes think about work while drinking it. Your home internet connection isn't fully deductible just because you occasionally check work emails. The key is legitimate business purpose and proper documentation. The IRS has seen every creative deduction attempt imaginable, and they have sophisticated systems for flagging suspicious patterns. Moving to our fourth myth, there's a persistent belief that cash transactions are invisible to the IRS. This misconception has gotten thousands of small business owners and independent contractors into serious trouble. The reality is that the IRS has multiple methods for detecting unreported cash income. From lifestyle audits, where they compare your reported income to your spending patterns, to third-party information matching where they cross-reference your customers' deductions with your reported revenue. If you're running a cash-heavy business like a restaurant or barber shop, the IRS can estimate your income based on industry averages and compare it to what you're reporting. They can also examine your bank deposits, look at your credit card payments, and even analyze your social media presence for signs of unreported income. Modern technology has made it increasingly difficult to hide cash transactions from tax authorities. The fifth myth that's particularly relevant in our digital age is the belief that cryptocurrency transactions are untraceable and therefore not subject to taxation. This couldn't be further from the truth. The IRS now requires cryptocurrency exchanges to report transactions. They've invested heavily in blockchain analysis tools, and they've made it clear that crypto gains are taxable events just like any other investment. Every time you sell cryptocurrency, trade one coin for another, or even use crypto to purchase goods or services, you've potentially created a taxable event. The IRS has been sending warning letters to crypto investors who they suspect haven't properly reported their transactions. And they've won several high-profile court cases establishing their authority to investigate cryptocurrency activity. Our sixth myth involves the romantic notion that filing for extensions gives you more time to pay your taxes. This misunderstanding has resulted in significant penalties and interest charges for countless taxpayers. A filing extension only gives you additional time to submit your paperwork. It does not extend the deadline for paying what you owe. If you owe taxes and don't pay by the original deadline, you'll face both failure to file and failure to pay penalties, plus interest on the unpaid amount. The extension buys you time to organize your documents and complete your return accurately, but any tax liability is still due by the original deadline. The seventh myth centers around the belief that married couples always benefit from filing jointly. While joint filing often provides tax advantages, there are specific situations where married filing separately results in lower total taxes. This might occur when one spouse has significant medical expenses, student loan payments, or when there are substantial differences in income levels. The key is running the calculations both ways before making a decision. Tax software can help with this analysis, but the important point is that marriage doesn't automatically dictate your optimal filing status. Our eighth myth involves the assumption that all retirement account withdrawals are taxed the same way. The reality is far more complex, with traditional IRAs and 401ks facing ordinary income tax rates on withdrawals, while Roth accounts provide tax-free withdrawals of contributions and earnings after age 59 and a half. Understanding these differences is crucial for retirement planning and can impact your tax liability for decades. The ninth myth that's gained popularity is the belief that you can avoid all taxes by claiming numerous dependents or declaring yourself exempt. This is not only false, but potentially criminal. The IRS carefully tracks exemption claims and has automated systems that flag suspicious patterns. Falsely claiming exemptions or dependents can result in severe penalties, interest charges, and even criminal prosecution for tax fraud. Our final myth involves the dangerous belief that the IRS won't notice small errors or omissions. In reality, the IRS processes hundreds of millions of returns annually using sophisticated computer systems that automatically flag discrepancies, unusual patterns, and mathematical errors. Even small mistakes can trigger correspondence or audits, particularly if they're part of a pattern or if they involve areas the IRS is currently focusing on. The truth about taxes is that while the system is complex, understanding these basic realities can save you significant money and stress. The key is to base your tax decisions on accurate information rather than popular myths. Maintain proper documentation for all deductions, And when in doubt, consult with qualified tax professionals who stay current with ever-changing tax laws. Remember, successful tax planning isn't about finding loopholes or believing in myths. It's about understanding the actual rules and using them legitimately to minimize your tax liability while staying completely compliant with federal requirements. Your financial future depends on making informed decisions based on facts, not fiction.